outset, I'll first tell you how many of you have joined this banking interbank quiz. Type yes if you have joined it. Those who have not joined it, what are you waiting for? Just 1 day is remaining now. Join fast. See, the quiz was on 22 and today is what, 21, right? So join fast as possible. What is the harm? See, you'll gain general knowledge, banking current affairs, and banking awareness. All these three would be tested of yours, and they are useful for you in CAIIB also. Remember this. So join fast immediately. Today everyone should join, and tomorrow in my class I'll again ask the same question and the answer should be yes. Okay, join fast. Go to Adda 24/7. Okay, so download Adda 24/7 app. Also join our Officers Adda 24/7 YouTube channel. On this app you'll get all the study material, live lectures, various classes, means all in one go. So join fast. Okay, what is the schedule for today's session? Today's session is on risk management. See, risk management is a huge topic. Yesterday also we covered some part of it. Today also we'll be covering the remaining part of it. Okay, so even tomorrow it can be the same thing because it's not a simple topic. Okay, so today's topic is types of risks, CRAR and its requirements, types of capitals, and case studies. Okay, these are the four points of today's discussion. Remember, they are very important. Watch the video till end. Okay, so what are the types of risks? We'll cover a few types which are important ones. Liquidity risk. It's an inability to obtain funds at a reasonable rates for meeting the cash flow obligations. Liquidity risk is of the following types. So basically, what is liquidity? If I am not able to pay my EMI at a given time, then I'm in a liquidity problem. Same thing happens with banks. If the banks are not able to pay their whatever installments of coupons, so then they are at a liquidity risk. Now these liquidity risks can be of which types? See this, funding risk. It is a risk of unanticipated withdrawals. Means all the depositors come to the bank for withdrawal of deposit. What will happen? There will be a run on the bank. That's called as run on the bank. Always remember this term which I am telling you. Run on the bank. Run on the bank means what? All the depositors come run on the bank. Okay, the bank. Always remember this term. Run on the bank means all the depositors come to the bank for withdrawals, and when such thing happens, bank is in deep funding trouble. And non-renewal of FDs, which are a raw material for fund-based facilities. So if the FD is not getting renewed, because here what is the present situation? The FD rates are going towards the lower end. Now, as they move towards the lower end, definitely people won't be able to renew those FDs, isn't it? Because after all, even the every human being will try to get maximum out of his funds, right? So that's why he won't be renewing it. So that is also always a funding risk. Second type is time risks. So time risk means what? At the required time, if I am not having those funds, then it's a problem. It's a risk of non-receipt of expected inflows from loans in time due to high NPA rates, which will create liquidity crisis, right? Means in COVID situation, there were huge NPAs. Why? Because people were not able to repay their loans, EMIs, interest, everything, right? So that is basically non-timely receipt of these means inflows of cash, right? They can be either through interest, they can be either through loans. Okay, what is the basic business of banking? Bank means here depositor deposits the loans, deposit, right? Then it goes to bank, right? And what does the bank do? Bank gives loans, right? Then on these loans earns interest, and then bank pays the interest, right? Interest. That is the basic model of banking, isn't it? Isn't it? And this commission is the one on which the bank runs, right? So this time risk and funding risk are always, if the loans are not repaid timely, then bank won't be able to repay the interest to those depositors. That is basically the time risk. Okay. Call risk. It is the risk of crystallization of contingent liabilities. What are contingent liabilities? See here, LC, BG, bank guarantee, right? Or availization. It's a separate topic altogether. I have taken it separately. So LCs and BGs, remember these two important parts. Okay, so these are the part of contingent liabilities. Crystallization means what? What is the bank guarantee? Let's say, what is the bank guarantee? Suppose if I am a bank X, okay, this is a customer A, and I give a guarantee for A to B. B is, let's say, a government organization. Okay, A wants to build a bridge. Okay, A is a contractor and he wants to build a bridge. So I give a guarantee on basis of A to B. And if this B comes tomorrow that okay, you had given this guarantee, this guy has not performed, so pay me. Pay. He comes to me. So that is known as crystallization. Okay, that payment part which is to be done is known as crystallization. Everybody understood up till now? Type yes. Everyone type yes if you have understood, because these things should be very clear to you. Okay, yes, 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 now you are typing. So okay, interest rate risk, risk of loss due to adverse movement of interest rate. Now what is this adverse movement of interest rate? Adverse means what? Reverse way. Now when can this happen? This is the type of market risk. Okay, because this is not in your hands. Is it in your hands that RBI will reduce the repo rate or increase the repo rate? Is it in your hand? Is it in your hand that RBI will reduce the CRR or increase the CRR? No. So interest rates are related to that, repo and CRR. So if the interest rates are reduced or it goes up, then this is known as the adverse movement as per my thought. Okay, my thought means if I'm expecting the rates to go up and they go down, so then it's an adverse movement. Okay, of interest rate. Interest rate risk is of the following types. So which are the following types of interest rate risks here? Gap or mismatch risk. Gap means what? What is the gap risk? Here it's like this. The risk of gap between the maturities of assets and liabilities means, keep it simple. Suppose if I take an FD, okay, FD of, I'll give you one example, FD of 1 year, okay, and let's say of 10 lakhs. Okay, and based on this 10 lakhs I give a loan of, let's say, 10 lakhs, same amount. We'll forget the CRR now. Okay, so I give the full loan of 10 lakhs to somebody. Now if I give this loan for 3 years and this FD is for 1 year, what will happen? After 1 year this 10 lakhs loan will be repaid to me how much? Only max to max 1/3, right? Because 3 years. So 1/3, some 3 point something, 3.3 lakhs, let's consider this much. This loan will be repaid only 3.3 lakhs. But this person who is having this FD, who is maturing is 1 year, this person will come to me for full 10 lakhs. So now what is this? I am having 3.3 lakhs and I have to give 10 lakhs. So this is known as the gap risk. Now how to fill this gap? To fill this gap for using some 6.7 lakhs, right? 6.7 lakhs is the gap. This 6.7 lakhs I'll have to borrow from the market. Borrow, right? Borrowing means what? Borrowing means cost, interest cost. So that will reduce my profits, right? Reduction in profits, right? After maturity of deposits, these liabilities are get repriced, and gap of interest rates between assets and liabilities may be narrowed, thereby reduction in of profits. Okay, so if I borrow it from outside, there will be definitely a cost for that borrowing, and that will reduce my profits. Similarly, non-renewal of FDs also. See here, for giving a loan of 3 years, I'll have to have 3 FDs of 10 lakhs, isn't it? Or 3 FDs of 5 lakhs, 5, 15, so that average becomes the same. So will I get the same FD after 1 year, because the rates may be down? So that is the risk of non-renewal. Okay. Next, basis risk. Change in interest rates of assets and liabilities may change in different magnitudes. Means what? See here, if the, let's say, the FD rates are FD rate is, let's say, 6% and loan rate is, let's say, 8%. Okay, 2% is my NIM, net interest margin. If this FD rate increases by 2% tomorrow and this loan rate increases by 1%, how will this increase 2% and 1%? Market conditions. Means what is the competition saying? Okay, market conditions, depending on that it will increase. So what has happened? Earlier I had an NIM of 2%, right? Now I am having an NIM of what? 6 plus 2, 8, and 8 plus 1, 9, so 1% only. Now this will again, net interest income of mine is reduced, isn't it? So this is known as the basis risk. When the FD and the loan rates change in different magnitudes, that creates a pressure on my NIM. Okay. So that was the type of risk. How to measure the risk? Risk is always measured based on sensitivity and volatility. I've covered some part of it yesterday also. So again go through that lecture. So sensitivity means what? It's again that the same as that of the Macaulay and the modified duration. So modified duration, which we had studied during modified duration. Everyone remembers? How many of you remember modified duration type? Type yes. Type yes. How many of you remember modified duration? Yes, right. We had Macaulay's and modified duration. Two durations we had in bonds, right? What is modified duration? For 1% rise, what is the percentage fall in the price of that bond? Isn't it? Always, if rate of interest rises, the price of that bond falls down. So it is a change in the market value. Same logic. Change in the market value due to 1% change in the interest rates. Okay. The interest rate gap is the sensitivity of the interest rate margin of the banking book. Now, what is this banking book? What is this concept of banking books here? Sensitivity. Sensitivity means for 1% change in the interest rate, how much am I affected in my P&L? Okay. So this sensitivity is checked using the sensitivity measures. Okay. Using this modified duration method. So what is this banking book? Banking book means here there are two types of books, banking book and trading book. Banking and trading book, right? What is banking book? Banking book relates to, I'll say, keep it simple, CRR SLR. Okay, CRR SLR. So why CRR and SLR? Because the bonds purchased in the banking book are never sold. Never sold. Okay. Whereas in the trading book, the bonds purchased are sold. Okay. So when they are sold, it always depends on the price of the bond presently going on in the market. Whereas this in banking book, whatever the price may be, I don't have to sell it at all, isn't it? So based on volatility, second part is it is a common statistical measure for dispersion. Dispersion means deviation. Okay. Around the average of any random variable such as earnings, mark to market, see this mark to market values, and losses due to default. Now what do you mean by mark to markets here? When I am selling this bond, at what rate did I purchase it, and at what is the present rate? That is known as mark to market, means the difference between the two. Okay. So before going ahead, we are having this going on with this crash course or selection batch from June 6th. Everyone should join this batch as fast as possible. Why? Because in this crash course we will be covering the entire portion of ABM, BFM and retail. Okay, and that will be sufficient for you to clear the CAIIB exam. No need to read any book, no need to go to any videos, any classes, anywhere. Okay, just follow this class and you'll clear it. 35 plus hours of ABM, BFM, mocks and ebooks, last minute preparation, recorded videos 24/7. So recorded videos, even if you miss some class, you can definitely get it again. Okay, solve unlimited doubts and use this code Y432. How to use it? I'll show you at the end. Okay, so next part which I promised was Basel norms, means basically capital adequacy, CRAR. So remember, CRAR is a part of Basel. Basel means Bank for International Settlement is situated at Basel. BCBS meets 4 times a year. That's all history. Okay. Important part over here is CRAR, capital adequacy ratio. It's always tier 1 plus tier 2 upon RWA. Now what is tier 1 plus tier 2? There are two types of capitals. Okay. Tier 1. Tier 1 is the bank's core capital, which consists of shareholders' equity and retained earnings. Okay. It's a free capital. Remember, tier 1 is always the free capital. Okay. Free. And this is always a paid capital, means I have to pay interest on this capital. Okay. So it is of the highest liquidity and can be liquidated quickly. It is a real test of bank solvency, because the more bank has free capital, the more free it is and the more it can use the funds. It doesn't have to pay to anyone. Tier 2 is includes revaluation reserves, hybrid capital instruments and subordinate debts. Means tier 2 I have to pay on that. Okay. In addition, tier 2 incorporates general loans and loan reserves and undisclosed reserves. So these two are also included in tier 2. Remember, we will be having this case study later someday. Okay. Tier 1 is intended to measure banks' financial health. Bank uses tier 1 to capital to absorb losses without ceasing business operations. So absorb the losses, because the more I have tier 1 capital, more I have free equity, more I have net profit, the better I will be in the position to absorb the shocks, right? Tier 2 is the supplementary capital, less reliable than tier 2, okay? A bank's total capital is calculated as the sum of tier 1 and tier 2. Regulators use capital ratio to determine, capital means CRAR, to determine and rank the bank's capital adequacy. Tier 3 capital is consists of subordinated debt to cover the market risk from the trading activities. Here, remember, tier 3 is always related to market risk and it should not be more than 250%, right, of tier 1, of T1. It should never be more than 250% of tier 1. Got this point? Okay, what are the minimum requirements of CRAR? As per Basel it is 8, as per RBI guidelines it is 9. Banks undertaking insurance business, it is 10%. New private sector banks, 10%. Local area and small finance banks, 15%. Okay. For declaration, dividend declaration by the banks, minimum 9%. So if the bank has to declare any dividend, then minimum 9% should be the CRAR. Remember, these two figures are very important: insurance business and new private sector. Okay. Now we'll come to the case studies. Daily volatility, these are some case studies I had already taken. The daily volatility of security is 2%. How much will be the monthly volatility? Here, it's very simple. Formula is like here, monthly equals to daily into square root of number of days. So what are the number of days in the month? 30. Okay, so daily into square root of 30. What is daily given? 2%. So 2% into square root of 30. That is over here. See here, 2 into 5.477. So answer is 10.95. This is how you calculate the monthly volatility. Remember, in exam they might ask you for monthly, yearly, any, weekly also. Even weekly, then same formula, just square root of 7. Okay. If yearly, square root of 365. Right. These are one-liners, okay, and these are simple questions. Just find the square root and multiply it with the daily volatility, okay. Next, per annum volatility is 30%. Number of trading days is 250. What will be the daily volatility? So same rule again. Yearly equals to daily into square root of 250, right? 250 days. So the yearly equals to daily into square root of 250, right? What do I know now? Yearly I know. What is yearly? 30. So 30 equals to daily D into square root of 250 is 15.81. So take this daily equals to 30 upon 15.81. It's 1.9%. So this is how we get the daily volatility. Right? If one day VAR of a portfolio is 50,000 with 97% confidence, in a year of 300 trading days, how many times the loss of any portfolio may exceed 50,000? So 97% confidence means what? Out of 100, 97 days, my loss is less than 50,000. So I am not at risk. I know this VAR will be 50,000. It's not loss actually. It's VAR, value at risk, means how much my fluctuations would be there, okay, in the capital. So for 97 days it's less than 50,000. That's okay. So what is unexpected? For 3 days it is greater than 50,000 out of 100. Okay, out of 100, 3 days it is greater than 50,000. So for 300 days how much it will be? For 100 it is 3. So 300 days it will be 9. So 9 days is the answer, right? One day VAR of a portfolio is 50,000 with 90% confidence. In a period of 1 year, 250 days, how many days times the loss of the portfolio may exceed 50,000? Now you answer yourself. Give me the answer fast. How many days? Don't look over here. Don't fool yourself. Okay. Try the answer without looking at the answer which I have given. Okay. Yes. Here. Out of 100, I'll write it over here. Out of 100, 90 days, it is less than 50,000, right? So 10 days, it is greater than 50,000, right? So out of 100, 10 days. So 250 days are given. 250 days, it will be 25 days, right? 10 into 250 upon 100, right? So it is 25 days. So that is the answer. So that was the point. These were the that was the schedule for today. Case studies plus tier 1 capital, types of capital plus risk measurement. Okay, types of risks. So we have completed the schedule for today. Again, I'll say tell you how to join the classes. I'll show you. Okay, that's very important. Means how to use that code. That's very important, because otherwise what happens? It's your money. We shouldn't lose on the money always. Okay. So look at this. Yeah. Hold on. Yeah. So are you seeing this site now? Go to Adda 24/7. On this site, on the front page itself, you'll see this banking, insurance, JAIIB, CAIIB. So go for JAIIB, CAIIB. On JAIIB, CAIIB, click to CAIIB. On CAIIB, you'll see the various batches over here. In the batches, click on the selection batch. Okay. In the selection batch, you'll see all the details which I've just told you. That 35 plus hours of ABM, BFM, everything extra. Read them completely. Okay. View those offers. In the view offers, because the fees is 13299. View the offers. What is the code? Y432. Okay. Apply this code. See here, your fees has come down to 3058 from 13299. So less. This is an investment for the lifetime. Always remember. This 3000 you'll recover once you clear CAIIB. 1300 is your approximate increment, right? 2 increments. So 1300 roughly. Even single increment for officer is at roughly 1200. So within 3 months you'll recover everything. So go for it immediately, and remaining after 3 months, whatever you have, it's yours. Okay. So go for it as fast as possible. Okay. Because don't lose on for your future. Okay. So I'll stop over here, and before going, I'll again tell you the big interbank quiz. Join it as fast as possible. Only 1 day is remaining. Okay. Go on Adda 24/7 and join as fast as possible. Okay. I'll take the leave. Tomorrow I'll come up with a new topic, and also see you in the live classes. So bye.